Now, another focus at the G20 summit is energy security. Here with a perspective on energy costs is Christyan Malek, JP Morgan's head of EMEA Energy Equity Research. Christyan, Anne-Marie was just talking about a number of factors there. Of course, concern on the supply side remains as it relates to the war in Ukraine. Then on the demand side, there is also the narrative around China and perhaps things getting a little bit better there. How do those two forces come together, and what are the implications for the oil market?
Yeah, it's a great way to put it, actually. I mean, we've sort of got this sort of triangulation of energy security in one plane, as well as delivering energy on another. And I've just come back from COP27, and what I see is more convergence around energy transition, enabling industry to provide energy, whether it be gas, oil. Clearly, renewables is a focus, as well as at the same time making it affordable. And I think the key point here is that underinvestment has come into the fore as something that we've highlighted for the best part of 2.5 years with our super cycle thesis, that ultimately, once we get that investment, we can start to close the gap with demand. But I think what we're missing here is that regardless of whether a demand is strong, moderate, or even soft, supply is falling back significantly against demand, and particularly in the energies that we need, such as oil, such as LNG. And as a result, I could see quite significant price action, which clearly makes energy security problematic.
Christyan, good afternoon. It's Guy.
Hey.
Why, therefore, is OPEC talking about the fact that it sees demand rolling over and it's going to act accordingly? You've got a big gap between the IAE and OPEC right now, and I'm wondering what resolves that.
I think what resolves that is inventories. Once we start to see inventories trend, be it in the US, be it non-OECD, and also, John, remember, I think one thing we've also sort of missed in the last few months is the dark inventories that are floating around the world, be it from sanctioned oil, particularly when demand's soft. That oil that was meant to be in those countries is rebounding back like a boomerang and finding its way back into Europe, back into the US, and putting pressure and creating more volatility. So with that in mind, if you take demand, the outlook of demand, plus where inventories are trending, that's where I see the big distinction between the likes of IEA and OPEC. And ultimately, OPEC are at the, if you like, at the sort of the forefront with the customer. They see most of the energy demand and oil demand coming from the east, and they can see the trends arguably before we see it through inventories. Therefore, if they're calling demand softer, that's a clear indication, particularly in China not recovering as quickly, which needs to be balanced through reduced supply outlook. And I think we've got to be careful that we go ahead of ourselves and try to focus too much on the front end and add more volume into the market. What we'll end up doing is paying for it later as the underlying trends catch up with us.
So how does that factor into your expectations for production and investment from some of the big energy players that you cover?
Well, we just had our energy conference last week where all the chairmen of the CEOs were there. And one of the things that we noticed is that underinvestment was a major theme. And what's interesting is that with windfall taxes continuing to put another block in terms of investment, we're seeing no new wells being drilled or developed or major projects. What that means ultimately is that we're going to see the majors production roll over next year. We cover all the companies. We can see the crude. And I always say crude, not NGLs, not gas condensate, but the actual crude volumes are declining. This is peak year. And therefore, regardless of how demand trends, we have an issue in terms of the supply outlook.
Christyan, how long does diesel remain elevated for?
I think ultimately, I mean, it all depends on how demand evolves for products in Europe. And I think ultimately we still have very good transport and mobility demand, which therefore means that I'd see it over the short term relatively robust.
And Christyan, finally, let's talk about the political landscape here in the U.S. We are still awaiting full results of the midterm elections, but it looks likely that there's going to be at least a small majority for the Republicans in the House. The Democrats have the Senate, going to be a divided government. What are the implications for energy policy in the United States domestically? How does that filter through to your world?
I think what will ultimately happen is that we're going to start to see potentially more isolation, focusing on U.S. consumers over above sort of what it means for the global consumer, in particular in energy. That translates into more energy security, which could see a variety of tools being exercised, particularly correlated to price. As prices continue to rise, as we expect next year, up to $150 Brent, we should be looking at that reaction function from the US carefully. Number one, do they look at banning crude or export products? Two, do they look at banning LNG? Do they think about windfall taxes? These are all the sort of, in some ways, you could argue the known unknowns. We've seen the playbook in Europe to some extent, particularly with windfall taxes, and I think all of those things are arguably on the table, but they're absolutely correlated to price. As price continues to rise, we could see a degree of overextension on mechanisms which shouldn't be there. But ultimately, when we look at all these mechanisms, particularly windfall tax, particularly discouraging investment through other mechanisms, not really fixing the structural problem, all this translates into a higher long-term oil price, because ultimately supply is still the loser in all of this.